SMF MMTs. Once again, this is a daily stock chart. We hit 550. We're using the 550 in this example as a trade management that we're going to do. We have dropped 20 points off of the high. This over here, MMTs, is what we call, and remember when I did on the 500 in that other video, same thing applies. Now, you can see where Google had made, look at these contracts here. This was the 550 put. When Google was getting slammed down over here, when Google was making its all-time lows, when Google on this daily chart, here, take a look at the daily chart. Now, take a look. I already did these on another video, so I don't really have to go through it with you because you know what happened. When we gap below that 200-day moving average here, that 550 was at its all-time highs. This is that 550 put. And that 550 put at the time when Google was in its bear trend and selling off was $27, and it made the high up here over $70. Why did the $550 put come down so fast? Well, because the $550 put was deep in the money, and it was totally inflated, MMT. Not only that, MMT, when you were putting the bottom in Google at 473 MMT, that bottom was put in for the rally, and that top inflated put came straight down. You can see how the put relative to the bottom rally up, and that put was inflated. They're never staying up here. Nor will an inflated call. Never going to stay up here. I'm sorry. Never going to stay up here. So when we put in the massive low over here in the equity price, we put the massive inflated 550 put that was deep in the money, and they took all that premium out. Actually, MMT, I will teach you a lesson as I always have. Notice that in the cycle, MMT, that the low here to the low here in this red bar or green bar, this was $27 over here. So you made a lower low here. This is where the first low was to that high. And they get so inflated that people don't sell them. When people don't know how to trade these correctly, what ends up happening from the inflated price, you made a lower low. Look at here. That was the first low. Let me show you. Here, that low was 27.10. This low here, which was made on Friday, is 14.70. People could take a great trade on the put side of Google and turn it into a very miserable loser like they always do. Not just with Google, but with any equity. They don't know what you know. They don't understand it, MMT. And the bottom line of it is, we do these things live, like we are now, before the fact. That's deflated. They popped this up right here. This was a side to be on. The low was 14.70. The high was 27.90. 14.70 to 27.90. So say you had 3 contracts or 10, 20, 50. It doesn't matter. You make big money. But here's the case. As that was being done, you were inflated. Now, Google reports earnings Thursday, July 14th. We're going to be watching the fact that if Google sells down going into the earnings and they bring these back to a deflated price, and, you know, we're going to get the trade management starting on Monday with these. We already did a bunch of these last week, and we got the big moves up. And, hey, we know when to be on the put side, and we know when to cash out, and we know what to do. Now, on that flip note, that's the 550 call versus the 550 put. Reason why that went down was deep in the money. You didn't get as much premium because this was, at the time, extremely low over here, and you could have bought these for 25 cents. You bought 100 contracts for 25 cents, and you cashed them in there. You didn't. That's $2,500 investment now. They were inflated over here, and they came straight down to 25 cents. They were way up and out of the money. The capital dollar risk was very minimal to be involved when Google was putting the bottom over here in its equity price. This is the equity chart. When Google was putting its bottom over there, buying up and out of the money for 25 cents, whether it ever got to the strike price or not, was going to yield you a premium. And even if you had a $250 investment, you could have cashed it in for 14,000 profit. Well, if you had 100 contracts, you made over 100 grand off of 2,500 bucks. You made over $100,000 on a $2,500 investment. Don't tell me otherwise. We do it all the time. You were here when it happened, and we enjoy this business immensely. And at the same time, we had put in the high, and we got deflated. So once again, inflated, deflated. Remember that Google moves about $30 to $50 when it reports its earnings, up and down. So there's going to be a lot of price volatility. Buying, we'll find out what kind of a trade we get to do. They took 100% premium out of these right here. You can see right here. You can see right here. $550 call. They took out 43% by the time it closed. And the 550 put right here got 59% premium at the close of the premium. Okay? In the money, out of the money. Google's going to make a big move, and we are going to put the trade management on tomorrow morning. 550 call versus 550 put.